Hello students, myself Dr. Narendra Rally, Assistant Professor, Department of Management, PG VSM College, Ramachandrapuram. I am here to explain you on the concepts of cost concepts and pricing, cost concepts and pricing methods. What are these cost concepts and pricing methods? First of all, cost. Cost considerations enter into almost every business decision. It is important it is important uh, to use right analysis of cost. The kind of cost concept to be used in a particular situation depends upon the type of business decisions to be made. Therefore, it is imperative to understand what these various cost concepts are, how these concepts can be operationalized, and how they are useful in different business decisions. The cost concepts, the costs are of various kinds. The following points highlight the 12 main cost concepts for managerial decision making. For managerial decision making, some of the concepts are direct and indirect costs. The cost concepts, the first concept is direct and indirect costs. What are the direct costs and what are the indirect costs? In the commercial world, some costs are incurred that can be directly attributed to the production of directly attributed to production. On the contrary, the cost of, for example, the cost of fuel, office and administrative expenses, depreciation and all, these are all these are all like indirect. Indirect, that is indirectly attributed to the production. They may not directly help the production function to move fast, but they help in making the production function fast. And the second one is the overhead expenses, and the second concept is opportunity versus outlay cost. Opportunity versus outlay cost. What is the opportunity cost? Opportunity costs are, we have drawn a distinction between outlay and opportunity cost on the basis of nature of sacrifice. Based on the nature of sacrifice, if we divided the costs, we can have opportunity cost and the outlay cost. Generally, in managerial decision making, a cost is not really a cost unless it requires a sacrifice of alternatives. Therefore, unless it is an opportunity cost. Therefore, the most important concept for managerial decision making is opportunity cost. And what is this outlay cost? The concept of cost, which normally enters into the accounts of a business, is known as outlay cost. It refers to the actual expenditure incurred. Actual expenditure incurred. That is known as outlay cost. Relevant costs and irrelevant costs. And the next one is relevant and irrelevant costs. The costs that will be incurred as a result of decision is known as relevant costs that incurred are relevant for future decision making, and the costs which have already been incurred irrespective of what is being done by the firms at present are known as irrelevant costs. And the next concept is past cost versus future cost. Joel Dean has drawn a distinction between past cost and future cost. He has highlighted the point that most of the important managerial uses to which cost information is put actually require forecast of future cost rather than the actual cost, that is, unadjusted records of past costs. The cost forecasting is essential for expenditure control, projection of future income statements like that, traceable or separable and common costs. Traceable, separable or common costs. Business managers often find it necessary to draw a distinction between common and traceable costs. Most modern businesses firms produce more than one product and thus they are faced with the problem of common costs. In such cases, it is difficult to attribute costs to particular products in as such as much as they result from the mix of products rather than the one product that is taken at a time. However, by applying incremental reasoning, it is possible to resolve much of the confusion. Out of pocket and book costs. And the next concept is out of pocket and book costs. Out of pocket costs refer to costs that involve current payments to outsiders as opposed to book costs such as depreciation that do not require current cash expenditures. But book costs are those costs converted into out of pocket costs by selling assets and leasing them back from the buyer. For example, if I have an asset, I will sell it to a particular seller and again I take the same machinery as a lease. In this cost we call it as book cost. You also have variable cost and fixed costs. So variable costs are those costs which change when the output changes, and fixed costs are those costs which do not change as per the changes in output. Till now we have seen various costs. Now let us explain cost oriented, pricing methods. The cost oriented or cost based pricing methods is the purest form of pricing method. In this pricing method, a certain percentage of desired profit is added to the cost of the product to obtain final price of the product. In general, we used to say cost plus profit is equal to cost per unit plus profit per unit is equal to selling price per unit. So, the cost of the product is the total cost spent on the production of the product. The following are the different subcategories of cost oriented pricing methods. In that, the first one is cost plus pricing. The cost plus pricing method is the simplest, and price of the goods using this method is determined by the following the most basic idea behind the concept of business. The price of the goods using a cost plus pricing method is determined by adding the unit of cost of production with certain percentage of profits. And the second one is markup pricing. The markup pricing can be determined by adding the cost of a product with a certain percentage of markup to determine the final price of the goods. The markup value of a product is the amount of profit the company wants to earn by selling product. To determine the markup price of the product, the company first should specify the exact total cost of production of a product and its markup value. The markup pricing is equal to product cost plus markup cost. The formula to calculate markup value is equal to unit cost divided by 1 minus markup pricing is equal to markup pricing equal to cost of production plus markup cost. The formula to calculate the markup cost or markup value is equal to markup value is equal to unit cost divided by 1 minus desired say returns on sales. The advantages of markup pricing method is the easiness of calculation of the final price of the product. Moreover, because of its simplicity, the most companies use this method to decide the final price of goods and services. Therefore, there are very few chances that difference between the price of the goods will take place. That means all companies will sell a product at a particular similar price. However, there are few disadvantages is that While deciding the price of the product, companies ignore the demand of the product. So the next one is target return pricing. Target return pricing. The target return pricing is a type of pricing in which the companies plan to achieve a certain level of return on investment by selling a particular quantity of goods. Here, the target return pricing is equal to unit cost plus the target returns pricing, that is T target return pricing is equal to unit cost plus desired return into the invested capital. The advantages of target return pricing is that it is easy to calculate and understand. Moreover, the company can decide the level of effort of the whole team as a unit required to generate a certain percentage of profit. The limitation is its accuracy to calculate the estimated amount of sales. And the next pricing category is break even pricing. I just want to let me explain to you what is the break even point before we get to break even pricing. The break even point is a point where the company is neither generating profit nor losing any money. That means the total revenue generated is enough to cover that it covers all fixed as well as variable costs of the production. If you The break even price is the price decided by the company to cover all fixed and variable costs incurred in the businesses. And the next point is early cash recovery pricing. The early cash recovery pricing is concerned with the early recovery of total investment in the business. The pricing strategy is adopted by those businesses who are aware of the short life of the market when they are dealing with fashion related products or the products which are technology sensitive. For example, smartphones or electronics, etc. Therefore, these are the cost oriented pricing methods. The first one is cost plus profit, markup pricing, cost of production, market pricing, and the markup, target return pricing, and break even pricing, and lastly, early cash recovery pricing. Thank you.